We're building the perfect dividend portfolio, today highlighting 11 dividend stocks with an average yield of 4.6%. Hey Bowtie Nation, Joseph Hogue here with the third in our Perfect Dividend Portfolio series, helping you build that perfect portfolio and live off your dividends. I'm covering every dividend type and strategy from high yield to dividend growth, monthly dividends, and ETFs. In each video, I'll reveal the best dividend stocks for your portfolio, stocks that are going to put cash in your pocket, including this week, highlighting one dividend stock from each sector. Let's jump right into it with the financial services sector and U.S. Bancorp, ticker USB, and its 4% dividend yield. This is a really interesting one because after holding it for almost 17 years, Warren Buffett has sold down almost his entire position in USB. Berkshire held over 42 million shares last year, but sold all but 6.7 million last quarter. And I think it's one of the worst decisions Buffett's ever made. U.S. Bancorp is the largest regional bank in the United States and books profitability that is unmatched even by the larger global banks. Its return on tangible common equity of 23.4% dwarfs the 15.1% return on Bank of America and even the 20% return on tangible at JP Morgan. USB has grown its dividend by 10% annually over the last 5 years, and with a payout ratio of just 43%, it can keep up that pace into the future. It's a bit pricey here at 1.7 times on a price-to-book value, but you're paying for that history of industry-leading profitability. After 17 years and lots of recessions, I can't imagine Buffett is selling for any macro reasons, but even if we do see a recession, with rising interest rates, the banks are coming into an era of profitability that we haven't seen in decades, and I really like the sector over the next few years. Next on the list, one of the safer dividends in the utilities sector, and Evergy Energy, ticker EVRG, with its 4% dividend. Evergy is a smaller player in the regulated utilities market with 1.6 million customers in Kansas and Missouri, along with good exposure to that renewables segment. Now again, this is a regulated market, so shares aren't going to make you rich, but they will hold up as stocks crash and keep producing that 4% dividend yield. The payout ratio of 68% is just slightly above the sector average at 65%, but still very sustainable for a utility company. What I like most about Evergy is its proven commitment to that cash return, with 9% annual dividend growth versus just 5.4% for peers in the sector. Nation, we've already covered the best high-yield stocks and the safest dividends in our first two videos. For this one, I want to start you with that diversified portfolio by showing you the best dividend stocks in each sector. And that means you'll never have to worry about one part of the economy losing your hard-earned money. You'll watch your portfolio grow and just keep collecting that cash flow. But you know, it can't be all about dividends. If you want to see the stocks I'm buying for the next 30 years, check out the link I'll leave in the description below. It's a free report I put together with the Motley Fool, the 5 stocks I'm buying for that 10x growth, my forever stocks. It's totally free. Just look for the link below and sign up for that free report. For the consumer staples sector, I've been following Conagra Brands, ticker CAG, and its 3.6% dividend for a long time. The company is a leader in the frozen foods and snack categories, with market share position in several top brands. Our shares of food companies were hit hard on inflation last year, but have started to pass those costs on through, and earnings for Conagra are expected up 13% this year. That means the shares are priced at just 13.6 times on a price-to-earnings basis. It puts the stock at a 25% discount to its longer-term fair value and a dividend that could follow earnings higher. The favorites over the last couple of years, energy stocks have flatlined since October, so I'm going with a safer name here, Phillips 66, ticker PSX, and its 4.3% dividend. Now, I like Phillips because it's got a more diversified revenue stream than you see in most large oil companies. Besides the familiar retail gas stations, the company has refineries, midstream pipelines, and chemicals business that really sets it apart. I love the diversification here, and it's got a strong balance sheet with enough cash flow to keep up those dividend increases. Oil companies are facing some tough comparisons with these first 2 quarters of the year. Oil spiked to $120 a barrel for the first half of last year, so now with the price back down to about $80, the group could disappoint investors when earnings are reported because of that comparison. But Phillips is paying out just 21% of its earnings to cover the dividend, so the yield is safe here, and the company has grown that payout by 7% annually over the last 5 years, more than twice the sector average. We're just getting started on our dividend stocks list, but I've got to say, it was extremely difficult picking just one stock from each sector. Watch through though and let me know if you think another stock should have made the list instead of the ones I highlighted. In healthcare, I like Amgen, ticker AMGN, for its 3.6% dividend and solid pipeline of new drugs. Amgen always has a strong pipeline with over 24 indications now in phase 3 trials. That, combined with the pending acquisition of Horizon Therapeutics for its immunology business, should help the company avoid the patent cliff in revenues a lot of other drug companies are facing. It will go a long way to continuing that 11% annual growth in the dividends the company has kept up, well above the sector average, and shares are now trading at a discount to fair value, so you've got some of that upside appreciation as well. This industrial sector stock is a little riskier, but worth it. Trinity Industries, ticker TRN, and its 4% yield, which is more than twice the industry average. Trinity operates in two segments here, railcar manufacturing and leasing with maintenance and services as an add-on, providing that recurring revenue. Now, earnings have dropped over the last year on an increase in cost, so that payout ratio of 109% is a little worrying, but profits are expected to double this year, bringing that down to a manageable area, and it's why the stock price hasn't crashed. Management increased the dividend in January, a strong show of confidence in that cash payout. And here, shares are trading at just 1.1 times sales, a 21% discount to the long-term average. So once we get that earnings growth return, we could see price appreciation on top of the dividend. In the tech sector, we've got one of Warren Buffett's biggest stocks, HP Inc., ticker HPQ, for its 3.5% dividend. HP is going through a tough environment this year. At first, laptop demand stagnated after everyone bought anew during the pandemic. Now a recession is threatening business demand for hardware as well. That said, though, shares are now trading at an attractive price. Buffett and his Berkshire Hathaway own more than 12% of the company, a stake worth $3.6 billion. And the dividend here is safe, with the company paying out just 25% of its profits and actually has been able to grow the payout at 13% a year over the last 5. When hardware demand recovers next year, this could be the stock to watch. With more than 2,000 dividend stocks in the US market alone, I had to use a strict stock screener to filter out for this list. I started with only those stocks paying a yield of 3% or higher. Any less than that, and it's just not much cash flow. Then I screened for 3 years of increasing payments and 5 years of dividend growth of at least 5% annually. Here, I wanted to start my search with only those companies with a clear commitment to increasing that shareholder cash return. From there, I could start my research, narrowing each sector's stocks down to the very best dividend payers. Here, I used a lot of the fundamental research we talk about on the channel, like comparing stocks on their payout ratio for that dividend sustainability, and then comparing growth in revenue and earnings. I also looked for companies with lower debt burdens. Folks, debt and that interest payment that comes with it is one of the leading causes of dividend death, so you always want those companies with the lower debt-to-equity ratio and that are paying down the debt they owe. In the communication services sector, I've got to go with AT&T, ticker T, against maybe the more popular Verizon Communications. AT&T is back to its roots as a pure-play telecom after that Warner Brothers spinoff, and I think the investors are underestimating the strengths in this stock after so many years of disappointment. AT&T has the strongest net subscriber growth after T-Mobile and well above Verizon's, and actually, come to think of it, I think AT&T surprised higher on these expectations while T-Mobile missed estimates in the last earnings report. AT&T is now paying a 5.7% dividend, which is below the 6.6% yield on Verizon, but there's more room to grow for AT&T. The company is only paying out at 45% of earnings versus 55% for Verizon, and AT&T has the stronger revenue growth, more than twice its competitor. I just think AT&T surprises the market with that dividend growth and share price, especially against these other telecom names. In consumer discretionary stocks, I highlighted Advance Auto Parts, ticker AAP, recently for its dividend growth. Not only has Advance grown its dividend from just 6 cents to $1.50 per share for 90% annual growth over the last 5 years, but I did some research last year into the stocks that held up best in a recession. Of the 500 stocks in the S&P 500, just 8 of them produced positive returns when the stock market crashed in 2008. Among those, Advance Auto Parts. That's because when people start worrying about the economy and their jobs, they fix up their old cars instead of buying new, and that means stable cash flows for auto parts stores. Advance has over 4,700 stores in North America, along with 1,300 CarQuest branded stores and locations in Mexico and the Caribbean. The shares are down 31% over the last year on weakness in that auto market, but now trade for just 0.8 times sales, a 27% discount to that longer-term average. Overall, it is a solid company with a 4.2% dividend and 49% payout ratio, so that dividend is secure. Now, while these 11 dividend stocks will spread out your risk by sector, some don't pay much for yield, so don't miss our video here, the first in our Perfect Portfolio series for the highest paying dividend stocks and the one I own. My materials sector pick is going to surprise a lot of investors because the company just cut its dividend. Newmont Mining, ticker NEM. It has been a tough year for the gold miners. The price of gold has come down from last year on those higher interest rates and a stronger dollar. Against this, inflation has pushed up mining costs and driven up that average all-in sustaining cost. Newmont expects to receive about $1,700 an ounce for gold this year, and paid just over $1,200 to dig it out of the ground. Now that still means profitability, but to protect its cash flows, the company did have to cut its dividend from 55 cents to 40 cents a share last quarter. That and just the weak environment has caused the shares to lose half their value over the last year. But this could be a great opportunity for new investors. It's the world's largest gold producer with 6 million ounces of production, along with revenue exposure in silver, zinc, and lead. Even after the dividend cut, it's still a 3.6% yield and lowers the payout ratio to 64% of earnings. Those earnings are expected 17% higher this year, which would lower the payout further to 55% and put the company back in the safety zone. Now, part of all this is that management had increased the dividend by 31% a year over the last 5 years, benefiting from that strength in gold, but way more than it should have. Now, though, the company is in better position, and you're going to see that price appreciation along with the dividend. In real estate stocks, I'm loving the recent drop in Medical Properties Trust, ticker MPW, as a way to pick up more shares. MPW is the second largest owner of hospitals in the world, with 442 properties and rare international exposure for a REIT, operating in 34 U.S. states and 9 countries. It's about 60% of the portfolio in the US, but also 22% in UK and throughout Europe. Our shares have sold off hard last year on the jump in interest rates as well as the healthcare reimbursements that failed to keep up with inflation. That's put a lot of hospitals at risk, and the stock plunged after its earnings released last month when it had to write down lost rent from a Prospect Hospital bankruptcy. But folks, the thing you have to remember here is that no tenant is more than 3% of MPW leases, so for any real risk to the company, the US would have to experience a healthcare catastrophe of hospital bankruptcies, and that's not going to happen in an election year. Even on the weak environment, though, the company reported $1.82 a share in funds from operations, almost 1.6 times the $1.16 per share dividend payment. So that dividend and the 9.5% yield is secure. We'll continue to see weakness on those higher interest rates and the poor environment for hospitals, but there are strong long-term trends for this healthcare properties, and I picked up 1,500 shares on the drop. Look for that link below to get your free report and see my 5 forever stocks, or click on the video to the right for the first in our Perfect Dividend Portfolio series, the highest paying stocks every investor needs. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.